and welcome to episode 119 of the REconomy Podcast, our second episode of this year's Summer School series, where we discuss economic issues that impact real estate, housing, and affordability. I am Odeta Kushi, Deputy Chief Economist at First American, and here with me is Mark Fleming, Chief Economist at First American. Hey, Mark, are you ready for the second class of the semester?
Hi, Odeta. Yes, I'm ready. And it's weird that you would say this in summer school, but let's go to class.
Let's go. Well, like any good instructor, we're going to start with a recap of the last class in case you missed it. In our first summer school episode, we talked about headship rates, essentially who forms households and when, and why that matters so much for understanding housing demand. Today, we're moving deeper into the next piece of the puzzle, what drives people to pursue homeownership or delay it. And we'll start by saying this. Many people assume the primary driver of the decision to rent or buy is financial, that it all comes down to affordability or mortgage rates.
That's right. But in reality, the first driver is lifestyle choices. The decision to become a homeowner is often sparked by life events, the need or desire for more space, stability, changes of location. Economic considerations, of course, play a big role in whether that desire can translate into action, but it starts with life.
Exactly. You can think of it this way. Lifestyle decisions create latent demand for homeownership.
Ooh, starting strong with a demand concept. Maybe a quick definition is in order. Latent demand is the potential demand for a product or service, in this case housing, that could turn into demand if it was more available or affordable. Sound familiar?
Sounds eerily familiar. Economic factors determine whether that demand becomes effective demand, so whether people can actually buy. So today we'll explore both sides, the life events driving latent demand and the economic realities shaping when and whether that demand is realized.
And over the last decade, we've seen this play out in real time, especially with millennials.
Yes, my fellow millennials, the largest generation in U.S. history, began aging into their prime home buying years. Demand surged, even as supply remained constrained. Then came the pandemic, which accelerated demand, reshaped preferences, and altered migration patterns. Many buyers fast-tracked moves they had been considering, driven by remote work, the search for space, or lifestyle shifts. So some of that latent demand that we were talking about was realized over this period, but there's more to come on that front.
Yes, and now as the dust has settled a bit, we're seeing how these lifestyle choices, when people marry, have children, change careers, or retire, continue to be major forces in the housing market. The timeline for those events has stretched out. First-time home buyers today tend to be older. Marriage and parenthood happens later, or not at all for some.
Great point. Actually, that reminds me of a specific demographic group that has been prioritizing homeownership. Beyonce has a song all about this particular demographic.
Ooh, I know this one. You are talking about all the single ladies.
I am indeed. And I hope now that song is stuck in your head. Now, while we know and we often say that marriage and family formation is highly correlated with the decision to become a homeowner, which is very true, over 20 million single women owned homes in 2024, surpassing single men in both number and in homeownership rate. Single women are increasingly flexing their buying power to purchase homes, making significant financial sacrifices in the process. These efforts underscore the importance of homeownership for this group. They recognize the long-term benefits of wealth accumulation through house price appreciation and equity gains from monthly mortgage payments. But I digress. I just thought we needed to insert that little piece of information.
It is a worthwhile digression, but back to what drives homeownership writ large. We all know that buyers today face significant affordability challenges, high home prices, higher mortgage rates, and limited inventory, all of which shape the market. But first and foremost, life events drive the initial latent demand to buy. So let's walk through the framework we often use to understand this, the 5 Ds of homeownership.
The 5 Ds help explain why people move and why they choose to buy rather than rent. So it starts with diplomas, and then diapers, divorce, downsizing, and finally death.
In chronological order, no less. Now, it is intentionally a simple framework, but important when you think about housing demand. Starting with diplomas. Education affects income, and income drives housing choices. But there's a nuance here. Student loan debt is often cited as a major barrier to home ownership. But our own research shows that while student debt can delay the home ownership decision for some, on average, it does not prevent it.
Yes, and the data shows that many borrowers with student debt actually have higher incomes than those without because they pursued higher education. It's about debt relative to income, not debt alone. High income borrowers with manageable debt levels often become homeowners just as readily as those without debt.
Yes, let's talk about this a little bit more because, as we mentioned, student loan debt is often cited as an insurmountable barrier to homeownership. And it's true that over the past 3 decades, average student loan balances have increased from $12,600 in 1992 to $40,600 in 2022, even adjusted for inflation. That's a big change.
That's a huge increase. And again, while that increase is substantial, a deeper look reveals that the percentage of income that young households dedicate to student loan repayments each month has actually decreased in recent years. So between 2016 and 2022, the average payment to income ratio for families with heads of households aged 25 to 34, so again, younger households, dropped from about 7% to 6%. How could that be, though?
Well, I'm so glad you asked. First, the average inflation adjusted income for young households with student debt increased from $73,000 to $122,000 between 1992 and 2022, an increase of nearly 70%. However, much like a mortgage, monthly student loan payments depend on more than just the loan amount and the income of the borrower. The average loan repayment term has almost doubled from 7.5 years in 1992 to 13.9 years in 2022, which lowers monthly payment to income ratios, just as extending a mortgage term from 15 to 30 years allows home buyers to borrow more money for a similar monthly payment. Almost doubling the student loan repayment term accommodates more debt for similar monthly payments.
And during that same period, student loan interest rates have declined. The average annual interest rate on student loans has declined by 2 percentage points from nearly 8% in 1992 to 6% in 2022. So, lower repayment terms and lower interest rates have increased education buying power while lowering payment to income ratios over time. Of course, it is important to consider whether the investment in higher education justifies the debt incurred.
And drum roll, please. Our research finds that it is. Higher educational attainment leads to higher household income, which in turn boosts house buying power. Among millennials, for instance, the gap in house buying power between those with a high school diploma and those with a bachelor's degree was approximately $250,000 in 2022, adjusted for inflation, further underscoring the impact of higher educational attainment on earning power.
Well, I mean, that helps to explain why in 2022, for example, the homeownership rate among millennials with a bachelor's degree was nearly 13 percentage points higher than for those with only a high school diploma.
That's right. So to summarize, student loan debt more likely delays rather than prevents homeownership.
Exactly. Okay, that was a bit of a digression, but I think an important one to point out. Now, back to those lifestyle factors. Where were we? We had diplomas, now diapers, right?
Yep, diapers are next. Starting a family is a major catalyst for homeownership. Parents seek more space, stability, proximity to schools, and community ties. But with family formation happening later today, this driver is somewhat delayed. And then, of course, there's divorce. When relationships end, new households are often formed, driving demand for both rentals and homes for purchase. In many markets, household splits can create notable churn.
That makes sense. Next is downsizing. As homeowners age, many seek to transition to smaller homes, lower maintenance properties, or locations closer to family. However, with many older homeowners locked in at ultra low mortgage rates and choosing to age in place, some of this turnover is being delayed. We talked about this in our first episode, so refer to that for more information about this concept of aging in place.
And finally, last but, well, maybe least in this case, death. Estate sales return homes to the market, and with older generations aging, this will influence supply dynamics more significantly in the years ahead.
Right. So the bottom line is that these 5Ds represent the lifestyle forces that keep the housing market moving through all phases of life. All right. So I think we need to start with what's pulling people into the market today. And I'm going to go with the first easy answer since we just covered it. The 5Ds are still driving demand. The need for space, proximity to family, or life transitions are pushing buyers and sellers to act, even in a particularly challenging market. Despite elevated interest rates and still high house prices, we're still seeing 4.7 million annualized total sales. So that's both new and existing home sales.
That's a great point. Though, based on the number of households in today's market, if we consider historically normal levels of activity, the total number of home sales would be closer to 6.8 million annualized right now. But I take your point. Even in a market with historically low affordability and high levels of macro uncertainty, people are still buying homes because life happens.
It sure does. Now, speaking of affordability, the other factor driving sales is income growth. Over the past couple of years, wage growth has remained strong, helping some buyers manage higher home prices and mortgage rates. In our latest RHPI, or Real House Price Index, we show that annual nominal house price growth was 2.2%, while annual income growth was 3.8%. So, income growth outpacing house price growth in today's market will allow for affordability to improve sustainably over time.
Right. And there's also the wealth effect from home equity. Homeowners today are sitting on a lot of equity built up over the pandemic era growth of house prices in the housing market. They could use that equity to bring higher down payments to their next home and offset these higher mortgage rates.
And of course, demographics remain a powerful force. Millennials and soon Gen Z continue to feed demand. Many millennials delayed homeownership for years, but the latent demand remains strong. We often see that when life stage needs arise, a new child, a marriage, or divorce, buyers enter the market even if rates are high. And that speaks to the fact that while affordability is critical, many moves are non discretionary. People move when they need to, not just when rates are ideal. But I guess that begs the question, why is that demand latent but not realized?
Well, let's go back and start with the part of the definition of latent demand because the cost of the product or service is too expensive. And in our case, cost of the product being affordability. Home prices remain elevated. Higher mortgage rates mean monthly payments are substantially higher than just a few years ago. But we are seeing house price declines in some parts of the country, and even nationally, house price growth is slowing and allowing incomes to catch up.
A little glimmer of hope there. Second, and also in the definition of latent demand, because there is a lack of availability of the product or service, in this case, housing inventory. There aren't enough homes on the market, especially entry level homes in the Northeast and Midwest markets. The lock in effect means many homeowners are still reluctant to trade up or down because doing so would mean giving up a 3% mortgage rate for a 7% one in this case.
And third, which is actually two more things, both cost issues, is student debt and credit constraints. While debt alone may not block home ownership, borrowers with lower incomes or tighter credit may struggle to qualify for a mortgage, especially in this higher rate environment today.
It's also worth noting that the pandemic brought forward some demand, and some of today's caution reflects that earlier surge, but the underlying desire for homeownership remains strong. It's just being modulated by economic headwinds. So I think the takeaway from all of this is that homeownership decisions start with life decisions.
That's right. And when life events occur, suddenly it's, this must be the place. Home is where I want to be. No? No?
Talking Heads reference again, by the
Again, it's
way.
such a good one. It's such a good
Yeah,
one.
you just mentioned this in our Homeownership Month episode.
I mean, the video, they're like sitting at home eating popcorn and watching home movies. You should watch it on YouTube.
It's a particularly relevant song. I think it's, right up there with We Built the City. These are the two housing
yes.
relevant
We haven't used that
80s
one
songs.
yet, have we?
Well, because we overused it for some time,
Oh,
and
okay.
now we can't keep mentioning We Built the City. And they are some of the most popular songs on our REconomy playlist, which you can find on Spotify. All right, so to really wrap up this episode, the 5Ds remain powerful forces, creating the latent demand and desire for homeownership, but affordability, inventory, and personal finances determine whether and when that desire becomes reality.
And in today's market, life events, not market timing, are the primary drivers of demand. People aren't buying because rates are low, they're buying because life is happening. And that's why understanding both the lifestyle side and the economic side of the equation is key for anyone trying to read the housing market today.
Great way to wrap up this class. Thank you, everyone, for joining us on this episode of the REconomy Summer School. If you have an economics-related question you'd like us to feature in the future, you can email us at economics@firstam.com. And as always, if you can't wait for the next episode, you can follow us on X. It's at Odeta Kushi for me and at mflemingecon for Mark. Until next time.